Fantastic. Thank you, Matt, and appreciate everyone's on the panel. I think this is a accounting 101. So we will start with some sort of simple subjects: the cash basis, modified accrual basis, and full accrual basis. So let's start with cash basis, which is the simplest and easiest to use and most notably used by smaller organizations, very small businesses. It doesn't, it's not the best accounting methodology for large organizations, but I'll go in through the pros and cons of each and what type of businesses use it. So let's start with cash basis. So cash basis is very simple. Revenue and expenses are not do not hit the books until you actually receive the cash for your revenue or expend the cash, disperse the cash. So it's very simple. So you can almost look at a bank statement and see what your revenues and expenses are when you're running on a cash basis. One of the positive aspects of the cash basis is it's very simple to use. That's why smaller companies, maybe sole practitioners, um, use this simple and very advantageous method of accounting. Um, because it's so straightforward. Now, one of the cons is that you don't always get an accurate picture of the company's financial health or performance. You could have bills, like outstanding debt that continues to grow, but since it's not hitting your books, it may not properly reflect where you are on any given time period. So it's certainly not generally accepted accounting principles. It's not what you call GAAP to run your books on a cash basis, but a lot of what you call mom and pop organizations use this methodology. The other methodology which is it's not as well known as the cash basis or the full accrual basis, is the modified accrual basis. And this is I've seen it primarily used by government entities or nonprofits, because it kind of takes bits and pieces from both the cash basis and the accrual basis. So a lot of governments like to use it. So for things like short-term events like revenue, uh, payables, things that are coming in and out on a regular short-term basis, it uses the cash basis. So a municipality will accrue will not accrue until all its revenue gets hit from taxes, for example, in November. So a lot of organizations use the modified accrual basis. They're in government or nonprofit or similar organizations. But things that are long-term events, like the purchase and depreciation of a fleet of cars or buildings, that portion of it is you does use an accrual basis. Um, it's like, again, most fiduciaries that will come across either a cash basis or a full accrual basis, and very rarely will it come across a modified accrual basis intentionally. There are a lot of fiduciaries will run into a somewhat accrual basis that has some cash basis elements to it, but not intentionally done that way. Just bad accounting. And last but not least, probably one of the most important ones, the full accrual basis, which is often referred to as the GAAP methodology. But just because you're running a full accrual basis set of financial statements does not necessarily mean you are compliant with GAAP, which can become there are a lot of guidance and industry specific guidelines that you have to follow in order for you to be fully compliant with GAAP. But full accrual basis is sort of the foundation to GAAP, and often it's used as interchangeably GAAP full accrual basis. But basically, if you're a public company, you're using GAAP. If you're a big enough organization with lenders involved, they're going to want you to have your financial statements prepared using a full accrual basis. So it allows for revenue and expenses to be booked when they are earned, and it gives full clarity as to when that revenue actually was earned and when those expenses were actually incurred, not necessarily when they are paid or received. Which is also the biggest con to a full accrual basis is that because of these differences between when you're actually collecting revenue or dispersing your expenses, you need to get CPAs involved and accountants, and it becomes way more complicated than a cash basis, which is very simple. So the timing difference is sort of the biggest issue derived between the cash basis and the accrual basis. When does that revenue actually come in versus when it's put on the books as earned?